Awesome. All right. Welcome again to this is our second Cut the Crap Investing Zoom call. I am your host, Brent Schmidt. And as I said last time, I met Dale a few years ago online and we've become good friends. And I've appreciated his perspective and support. And while I'm not personally in the retirement stage, I know many of you are, and I look forward to a productive call today. Help you get answers to your most pressing questions. I'm going to let a few more people in here.
Sure, yeah.
And again, I'm here to support Dale. We'll manage the tech side of the Zoom. And Dale.
Thank you for doing this, Brent, once again.
Yeah.
Say that
Go for it.
It's greatly appreciated.
Yeah. Do you want to?
Because I wouldn't be able to do all this.
Do you want to say a few things there, Dale?
I don't know how to press all the buttons. Is this my bio or?
Yeah. Well, it's like, again, just welcome everyone. If you want to say hello.
No. Yeah. Thanks, everyone. Thanks for joining us, and get your questions ready, of course. And what doesn't get answered today, once again, always feel free to send via Cut the Crap Investing site. Just use that contact button on there, and that goes right through to my email. And I'm happy to reply. If I don't reply, please bug me. I get a lot of emails, but I do want to follow up with everybody. So if I miss you, really feel free to bug me. I really enjoy doing the research because I'll learn, and obviously I like helping people out. That's why I started the blog.
Exactly. All right. Do you want to do your disclaimer?
Disclaimer, of course. So there's lots of stuff going to get thrown at you today, even including that 7 ETF retirement portfolio. Remember, this is for informational purposes. It's all about the education process. It's not advice. I mean, use it to build on. I like what they say at Seeking Alpha, where I write. It's like read, decide, and invest. And I know that some folks will take it and run with stuff. I get that, but keep in mind that self-directed investor, it's your own call and your own move. So this is for informational purposes, if you will.
Awesome. Yeah. So the goal of the call, as we is to, again, help you evaluate your current standing with your retirement portfolio and chart your path forward, help you feel more confident in your future. And so we're going to, in terms of the way this call will flow, we're going to start with a presentation as we did last time. Dale will lay his foundation for us around his perspective. Then we're going to have some time for you to ask questions. As we go through the presentation, if you do have questions that come up for you, feel free to put them in the chat. I will review them and we can answer some of them live today. We'll also have time to, if people want to just raise their hand, there's a raise hand feature as we did last time. And we learned from last time, it's helpful if you just kind of focus on one main question. If you do raise your hand, just to make time for other people. So if we have time at the end to come back to, we'll do that for sure. But we'll get to that later. And again, it's good to remind everyone here to have a successful call. Just to stay muted, minimize your background noise. Again, we'll use the raise hand feature when we get to the Q&A, and we just always invite everyone to stay open to new possibilities, new perspectives, and just do yourself a favor by being present. Shut off any other distractions. I always turn off my cell phone, just so you can get the most out of this time you're investing with us today. So again, let's use the chat. We'll use the chat feature a few times today, again, for questions. Just put the city where you are located. Again, just remind us where everyone is. And there's probably some new people that weren't on the first call. So just what city are you in? So just put that in the chat. Vancouver, Mississauga, Ottawa, Airdrie, Alberta. Cool. Montreal.
All right, Denise, Calgary, great. Moving across the country. There you go. Now we're BC, yeah.
All right.
East
Great.
Coast represented. There we go.
London, excellent. My hometown. We're going to run the same two polls we did last time. Again, we'll see where the group that's with us today is at. And the first one is the stage of investing. So I'm going to launch that poll. It should pop up on your screen. You just choose what phase are you in, the accumulation or retirement decumulation phase. Last time it was 50-50 approximately, right, Dale?
Mm-hmm. Believe so, yeah, around there, yeah.
Okay. looks like we're almost there. Give you 3 more seconds to just weigh in if you want to. All right, I'll end that poll and I'll share the results. You can have a look there.
Cool. Good.
Yeah, makes sense.
Yeah, in the right place.
The right people are here. Okay. All right. And then I'm going to launch the next poll here. Just a second. Next one is about, let's see here. Skip the last one there. So how confident are you today that your portfolio has the right mix to achieve your goals? Again, thinking about where you're at with retirement. Oh, you didn't see the Trey, you didn't see the poll. I'm not sure how to solve that for you.
I had it, came up for me.
Should just pop up on your screen. Sorry if you didn't see it. Trey, you can just put for this one, it's just, are you very confident, fairly confident, not very confident, or not at all confident? I don't, in terms of your investment, you can put that in the chat. Oh, you got it. Oh, great. Okay, good. Looks like, okay. 36 to 38 of you. I'm going to close the poll in 5, 4, 3, 2, 1. All right, 36 out of 38 looks like. So there you go. You can see the results there.
Good.
Just gotta let someone else in.
It's a good mix that skews to confident, which is nice to see.
Good. Awesome. Okay. Close those polls. Thanks everyone for doing that. It gives us
Thanks everyone. It's good.
Your confidence can change from one week to the next sometimes.
Especially in this environment too.
It's good to check these things. So Dale, why don't we move over to you now and you can walk through the presentation, and this will take about 6 minutes or so. And again, feel free to put your questions in the chat as Dale's going. And I'll just hand it over to you.
So it is, bear with me here, folks. I have 2 screens, so I'll share this one here. Is it looking okay? You came up?
Yep, we got it.
And then I have another screen here, so I'm going to go back, and that's why I'm looking off to the side here. Okay, so welcome to the retirement stage. Of course, this is Dale Roberts, and I'm the Chief Disruptor at Cut the Crap in Investing. So in our first Zoom meeting, we realized that wealth building would be and should be one of the most rewarding and stress-free things we do in life. We simply buy growth assets on a regular basis, we save a lot, and we invest a lot. Retirement is more complicated. In retirement, or the decumulation stage, as we call it, we're looking to maintain enough portfolio growth as we protect enough wealth at the same time. So retirement really is about playing offense and defense. Again, on the offense, or my phone's going here, we'll have stocks and REITs and other growth assets. On the defense, we're going to have bonds and cash and annuities. Other stuff can certainly factor in, but those are the core basics, if you will. And then there's inflation to consider as well, right? So stocks can work over the longer term. We have gold, commodities, and energy. We'll go over sequence of returns risk. The reason for that is there's a series of bad years for stocks and REITs at the beginning of the retirement start date that could impair your portfolio. We really need to greatly respect those bear markets. And again, we will call that the sequence of returns risk. So here's a retirement funding example, okay? That is to say the portfolio is delivering income to the retiree. The all stock portfolio in blue is severely impaired, and this is during the great financial crisis of 2008 to 2009 and beyond. The balanced portfolio with a nice mix of stocks and bonds, again, that simplicity of the balance, declined much less, and you can see that it recovered much quicker. So even if we go back to another major correction, this is even worse for the all stock. If we go back to either the 1970s or even the 2000, the dot-com crash, where again, stocks really got pummeled. So we're trying to avoid that terrible start date. And again, really is retirement funding is about safety first rule. You can manage the sequence returns risk by holding enough defensive assets. In fact, you could actually remove the sequence of returns risk entirely by holding a very defensive portfolio. But then you would have replaced the sequence of returns risk with the risk of not meeting your retirement goals. your portfolio simply doesn't have enough growth. You certainly need that balance. Again, a simple balanced portfolio that we've talked about a lot. That is the traditional well-balanced mix of 60% stocks and 40% bonds, globally diversified. Historically got the job done for retirees in most, but not all periods. The balanced mix offered the ability to fund retirement needs for 3 decades or more. That's kind of the standard measure, if you will. And of course, as always, past performance does not guarantee future returns. So how big a portfolio do you need? Retirement planning is often based on a rule of thumb called the 4% rule. The guidelines suggest that with a sensible retirement-ready portfolio, you can spend 4% or more of the portfolio value each year, and that is also adjusted for inflation, which I'm sure is going to be a topic of the day. And that rule, again, is based on a 60-40 balanced mix. And here's a $1 million example to put it in perspective. Excuse me. So if we have a portfolio with a value of $1 million, that would be able to deliver $40,000 of annual income adjusted for inflation. And again, typically lasts for 30 to 35 years. Again, we won't always use the 4% rule, but it does give you a ballpark on how much you need to save and invest and how much your portfolio can spit out by the way of income. And of course, remember too, we also do have to factor in taxes into this. Readers of my site will know I did offer up a 7 ETF retirement portfolio. Again, not advice, but for consideration. And in this one, the 7 ETF, in place of large cap Canadian and US stock market ETFs, I used a high dividend ETF for Canada, that's Vanguard's VDY, and also a lower volatility dividend growth ETF for US stocks. It kind of mirrors what I do with stocks on that front, but this is the ETF version. And again, Vanguard's VIG for that US. I've added REITs, real estate, and you'll also find a slice of BMO's monthly income. Keep in mind, again, not advice, but a demonstration of a very easy and simple portfolio mix. That inflation protection stuff. So inflation, of course, is stealing the headlines these days for the first time since the 70s, hence the Beetle camper van image and the jacket I'm wearing today, my shirt. Investors might choose to add dedicated inflation fighters. Well, stocks historically are great. I mean, they're the engine of the portfolio. They'll deliver returns, above inflation for many decades or over many decades. They don't always work in the moment when inflation is raging. They don't offer returns that match the unexpected inflation or stagflation. So real assets and energy stocks for inflation. It's a personal choice. I employ some gold, real assets, plus oil and gas stocks. And a simple solution for this, again, is the Purpose Real Asset ETF. It's ticker PRA. I talk a lot about, on the site, and also put it in portfolio mixes here and there. If you want energy stocks there are index ETFs such as iShares XEG, BMO ZEO. And for this, you might consider about a 10% allocation at least to these dedicated retirement or inflation fighters. And to make room for the inflation fighters, you can trim equally from the rest of the portfolio. And we should touch on this. What about that big dividend approach? Because we are in Canada and we know how many of you do invest. So many retirees will feel more secure if the retirement spending needs are covered by dividends and other specialty income. It is true that if you need your portfolio to fund at a level of 4.5% and the dividend yield is 4.5% or more, you have eliminated that sequence of returns risk. That said, that retiree might be sacrificing sector or geographic diversification. And again, there's no guarantee that dividends will keep growing or even hold steady in times of bear markets. So I'm a fan of the hybrid approach for dividends, and that would be, again, where generous and growing dividends are part of the total mix. That's a great asset for Canada that we have those great growers that work in an oligopoly situation as well. But again, the dividends for me, they're not the sole focus. And we'll save this discussion for another day, and it will be a dedicated Zoom call and video, and likely the next one. So it's a topic, a lot of Canadians invest this way. I'm a hybrid, so I think it's worth covering because there is some merit in the hybrid. And here's just another quick way at it. If we want to manage the sequence of returns risk, we can have a variable withdrawal plan. So when times are good, we spend a little more. And when times are bad for markets and long bear markets, we will spend a little less. Think of them as guardrails for your retirement spending. And many planners would suggest that we would reduce spending by about 15% or slightly more when markets are getting hit hard. And that's, again, in a a longer bear market, if you will. And again, I will write a dedicated post on this strategy. I have a couple of readers who know this stuff inside out and use it, and I'll get some help from them, and I'll put that into a dedicated post. Now, keep in mind your portfolio, again, is just one piece of the puzzle, right? You might also have income from government pensions, private pensions, real estate, inheritance, home sale, downsizing. There might be HELOC. You might work part-time, have a corporation. There's a lot of moving parts. And it can be a bit of a puzzle, if you will, for that retirement funding. But again, it's not that hard to get the pieces in the right place. And it's not difficult to get what we call the optimal order of asset harvesting. And here's an example of the complexity at times, if you will. So you may know this, if you delay your CP, you could get a 42% raise over time, right? So if you're eligible to take your CP at age 60, but if you delay your Canadian government pension until 70, you would receive a payment boost of 42%. And then you would move into something that is, again, then inflation adjusted, right? So we'd use other assets, such as your portfolio, to fund retirement to take you to that age 70. I'm going to give you an example from our friends at Cash Flows and Portfolios. So this is a service, and they help self-directed investors, and they are self-directed investors themselves, discover an efficient order of asset harvesting. So they'll run a lot of the same tools and models that a planner will, but again, they are operating as self-directed investors as I would, if you will. That is, what account types do you need to draw from and when? At times, it may be more efficient to do what they call NRT, which is spend more first non-registered dollars, then RSP, and then tax-free. But that said, you might be better off with an RNT, where you pull first from RSP, then non-registered, and lastly, tax-free. Every retiree is unique, and every retiree will require a dedicated solution, if you will. But again, they can run those tables, and they've been doing it quite a bit, and they're very good at it. So again, you might have several or more sources of income, and there are a lot of moving parts. There are tax and estate considerations. The expertise required, frankly, is outside the bounds of a typical self-directed investor. And it's very important that you seek help, in my opinion. You might consider an advice-only planner. Again, you can pay a one-time fee. You don't have to hand over a portion of your retirement portfolio on an ongoing basis. And I'd say if you can avoid it, absolutely do that. And here we go. Here's our advisor. So we want to fund your retirement, not an advisor's. Again, fees are always important, but consider if you need your portfolio to fork over 5% annual, let's say, excuse me, you're paying an advisor and a mutual fund 2% in annual fees, you're losing 2/5. 40% is going in the wrong pocket. Again, you can check in with the folks at Cash Flows and Portfolios. They can do that service for you, or you can pay an advice-only planner and then move on to manage your own investments in a low-fee manner. And here's the wrap up. Again, obviously, this is a very basic overview of the retirement stage, but I've attempted to hit on some key areas. And again, fees are important, and certainly you can build your own successful retirement portfolio. It's not that difficult, but you will likely need help in these other areas. And in my opinion, that will be money that's very well spent. So feel free to send me a note, and I can pass along some options for advice-only planners. I have a lot of readers who come through every week saying, you know what, I like the idea. I want some help. Can you throw a couple of names at me? Again, it's not advice even to use A, B, or C, but I can assess your situation if you need a retirement specialist. What I've done too is just building kind of a book on a lot of folks out there, and I'll ask the retirement specialists, I go, who do you like? Who do you trust? And we start to get a consensus, and I get some feedback from our readers as well. Again, so feel free to reach out in that regard. And again, so thanks for watching this. And again, check out my blog, of course, for lots of retirement focused stuff. Also, Money Sense is a regular stop in Cash Flows and Portfolios. They actually have a lot of good content on there as well. So thanks for listening. And I think Brent will take over. We're going to move on to some other stuff and some polls there's questions, I think. Yeah, here we go.
We're going to jump to the Q&A. Great stuff, Dale. Thanks. All right, so there's a few questions in here. Again, we have another 40 minutes for questions, so lots of time here to. Awesome. And if you under the reactions on the bottom of the Zoom there, if you click on it, you'll see a raise hand feature, the bottom bar. You'll have to lower your hand after as well. So if you want to ask a live question, feel free to do that. Put your hand up, and we can get you to ask your question. Well, there's a few here in the chat, so why don't we
Sure.
just start with some of those? So John's asking, do you have any comment on alternative mutual funds? We'll start with that one.
Alternative, you know what, it's not, again, I have to guess about what you mean by alternative, maybe alternative assets. There is a growing stage, if you will, in area. I don't really think that they're necessary. But again, let me, before I give an answer, let me do more research on that. And well, I certainly think we can do better than a core portfolio for retirement. The alternative stuff coming in, it is growing. And I think they can be put to use. As you know, like pensions will use this, family advisory shops will add those in. But again, I haven't researched them enough to give a solid opinion, to be honest with you.
Okay. John, do you have any other questions around that? I know you're off screen there, if you want to ask anything else around the alternative. He also had another question. I asked him, NFI Group Inc. Do you have any comments on that?
On which one, sorry?
He says NFI, is it NFI-T, NFI Group? Do you know about them?
Not sure. No, here, give me a second, because maybe, or somebody can Google, find out what that is, and we can go back to it.
Okay, you're good, John. Okay, we can get
Is
back.
that is it maybe a stock? Is it NFI? Is it -T? It might be. Is it a fund or? Oh, the bus company. Yeah, you know what? I keep my stock stuff really simple, as you may know. So I've heard of that one, and I'm just really careful when especially in the retirement stage of what I would build. Again, I really like that core, and that'll come up when we do the dividend stuff. Building the lower risk assets, if you will, certainly with a growth kicker. But yeah, I think we really have to be careful with our individual stocks and not go for the winner or the big growth hit, if you will.
Okay, thanks. There's a couple requests for the advice only planners. Do you have some names, or could you include that in?
Yeah, I mean, it'd be things like, Money Coaches Canada, I think, is a really good place to start, if you will, because they do have a lot of folks there, and they are varied, if you will, in their expertise. They do have some retirement specialists. I think that's a good place. Obviously, I mean, Alexandra McQueen is really one of the best retirement specialists in Canada. She deals with, understands the annuities and how to use those. Those are really underrepresented, if you will. So again, she has penned probably the most read posts on the site, actually. Folks really gravitate towards that. But again, I do have a list. There's Bespoke is another one. And but again, just reach out, and I do have a list, and I'll kind of try to tailor it as well. But again, I think it really is helpful for folks. Hey, keep your own money in your own pocket. I think most of us will need advice. Go get it and pay for it a la carte. Don't give someone 1 or 2% a year. I mean, if you have somebody out there and it's working great and they add value, that's fine. But I think if you can find a way to do it yourself, it's money well spent to keep the money in your pocket.
Okay. And there's a comment there from Catherine in the chat. It's like she's happy with Ayana Forward, I think is what her name is. So
okay.
Have a look at that potentially as well.
Okay. Oh, so I open up the chat, sorry?
No, someone, Catherine has posted in the chat.
Okay.
Yeah. So just an option there for advice only.
Okay.
Planners, yeah. Charlie's wondering about, can you give more detail on your hybrid approach, the % of dividend stocks versus ETFs?
Okay.
I know you're going to do it. We'll do a full show.
Yeah, no, I can touch on it. But really the idea is like defensive assets would, work in the place of bonds, right? So you can start with, telcos and utilities, pipelines can layer over there as well. So they're going to be defensive. Obviously, stocks are not bonds. We get that. But, given the low yields of the day, there's been some advisors in the past that have, had used layering of dividends very, very successfully. Arthur Salzer, now who runs Northland Wealth, a family shop, he tutored, if you will, under one of the major guys who did that way back in the day. So for me, I wouldn't get rid of the bonds entirely because they act differently, but I think you could bring the portfolio down to even like an 80% stock level and 20% bonds and cash. And Yeah, and just layer in, you're going to have, more volatility, of course, even though the utilities can be lower volatility assets compared to the market. But yeah, I think you get down to that area, and a lot of people for decades, you'll hear from a lot of retirees that have successfully used a 100% stock portfolio. But again, they're going to layer in the defensives versus the growth, if you will. And my idea would be to put in some inflation fighters as well, because they likely haven't gone through an inflationary environment, right? So, and again, keep in mind that if we move into recession, and we obviously that's low growth and everything, the commodities will get killed, right? My oil and gas stocks, probably not going to do well. So we have to keep that in mind. But that's again why we have that all-weather portfolio. We have to be ready for certain assets to not do well, right? But something should be working. So again, yeah, you could get really aggressive where you could have your stocks to 80, 90%, and some will go 100%. You can build and shape it that way.
Well, related to that, we're talking about this balancing, right? The mix, right? So there's a couple comments there about using VGrow. So Trey is asking, how does VGrow, which is that the 80-20?
I believe it's in the 80-20. Someone can throw it. It might be 90-10, but I think it's in the balance growth. So it's in the 80-20, if you will.
Yeah, VBAL.
So my take on that, it's really aggressive for a retirement portfolio. But keep in mind that when we throw the 60-40 in there as a suggestion, right? Or that's what planners will kind of work around too. Typically, when you nudge the stocks higher, you have greater level of success, but you create a little bit more risk for, like, let's say we get a depression, right? Which nobody thinks could ever happen, right? A VGrow or an 80-20 is probably going to get crushed pretty bad, right? So there's the emotional component. It's hard to navigate through when your portfolio is going down by 30, 40, 45%. So typically over longer periods, and if we go look at the last, 10, 20, 30 years, that kind of mix would work well, because keep in mind, we've been in a disinflationary low growth environment forever, right? That's all we know. We don't know inflation. We don't know depression. We don't know rolling recessions, right? So we can have a bias to think the recent history is going to repeat. But again, that's why people think bonds, why hold them? Because it's a guaranteed loss. But let's say we do go into the recession or worse, or rolling recessions, right? We are going to be glad that we have those bonds for that component. And we're going to be glad we have those defensive stocks, if you will, maybe the telcos and utilities. Well, if we want to shape the portfolio, which we can by types of stocks, right? For retirement, it's not just doing the stocks and bonds. We can shape to more safety, if we will, by layering in certain types of stocks, if you will, right? Yeah.
Okay. And how does
anything there?
And the VGrow versus the 7 strategy ETF, is the VGrow more aggressive then?
Yeah, again, the VGrow would be more aggressive, but certainly again, you could take that 7 ETF and you can dial it up or down, right, as you like. If you want to dial up the stocks, let's say you want to dial up the income, you could dial up the BMO monthly income is wonderful, right? It's only in there at 5%, but it could be 10%, 15%, whatever you like. You might also dial up the Canadian component of the VDY, which is the high dividend stocks, right? Keep in mind, you're going to probably be allocating more to Canada, of course, and that currency risk and such. But you could dial that up as well. But in its current state, yeah, that 7 ETF is, as an example, is slated. I believe there's 45% core bonds in there, whereas again the VGrow is quite aggressive. So the VGrow would work. Just be prepared. And I think when I put in that variable withdraw slide in there, that may be the thing. You're rolling the dice with something that typically works better. But if the markets start tanking, you just realize that. And of course, no retiree is going to start slicing big chunks out of their portfolio when it's down 40%, right? It's just against human nature. So I think even just by design and by emotion, I think we would introduce our own variable withdrawal plan where we go, I don't want to raid the portfolio too much at this time, right? But keep in mind that there are strategies. Again, these are all ideas on the table. Go do some research on that. I'll do a dedicated post, have some readers that use this with great success.
Okay. And just briefly, again, we're kind of on this VGrow. San is asking, should I do VGrow in RSP and VEQT in TFSA? iShare or Vanguard? Any preferences? I don't know if you have any more around that.
Once again, I think that's the kind of stuff when we start talking about what goes where, and there's tax considerations and stuff. And I think that's where you need to get help, So I don't want to start having some, some general ideas on it. But I would say never let, taxation completely, even withholding taxes, drive the bus. The most important thing is our asset allocation and our risk management. But I think that's one of those things where if you go to like the guys at Cash Flows Portfolios, or you go to a retirement specialist, they are going to show you where everything moves. And I've been just find out and get that optimal mix, if you will. And here's the thing, we don't have to be perfect, right? Just think, if we're self-directed investors, we're doing something that is really great, is we're keeping our fees next to nothing, right? And then we might go get help. There is no absolute perfect strategy, because we don't know the future of the returns, right? We just make really good estimates. And I can tell you, I've been talking to those guys at Cash Flows, like they love what they're doing. They run models like crazy, and they love it. And they learn more every week and how they do it.
Okay.
And again, they're not going to get perfect, but they're going to get you to a better place. And again, whether it be advice only planner or those guys, it's going to be money well spent to know what goes where and when and why.
Great. Okay. We've got some really good questions here. I'll pivot a little bit away from this. I'll jump back to something different here. Dale has asked, Steve is asking, what are your thoughts on longevity pension plans?
Oh yeah, I've penned on that. I think it's wonderful, and I'm actually speaking with them right now about another post and how that fits in with the full retirement plan. So again, as you know, the Purpose Longevity Pension Fund, if you will, it's kind of like, if most of us aren't blessed with a government work pension, or even private pensions they're just a thing of the past, right? So this is kind of the private pension for the masses, if you will, the ones that don't have a work plan. And I think it's really, really good. It's really sound. Even some retirement specialist friends or whatever planners have looked at it and they like it, and how it can fit in. And what's nice there is it has those the credits, if you will, of the so what's the proper words, but it's essentially a death credit, right? If the folks who live longer get paid for by those who passed away earlier. So it's actually loaded at the end as well, which we go, oh geez, I don't want all this money when I don't really want to spend it because I'm older and don't have the energy. But think about I know with my mom and others, my mother-in-law, the cost to go into a retirement home will shock most people, right? So having that boost at the end, if you do live longer, and maybe you live to 90, 95, 100. My mother-in-law is 94. She's going great, right? It's incredible how long folks are living. Now she sold her house and had some good money and has some good investments, including there's a lot of good dividend stuff in there for her as well. But I think it's really good. I think it's worth exploring, and I'll do that post, and they're going to get some help with some retirement experts as well. That how does it fit in? Because it's not think of it as like an annuity, if you will, right? It's not use it for the whole thing. Okay. It fits into that bucket like an annuity. It is your cash part or component. It's a payout, right? That's going to be coming in.
I see.
A little more secure. There's not guarantees on it, but they back tested it. So I do like it. And I do like the idea of annuities as well. And again, Alexandra can go over at the right time. It's not typically early, but as you get into you're 70, 75, now all of a sudden the annuities are paying out like a great amount above bonds, if you will. So yeah, keep watching the site. I do like it.
Great. And so related to the pension question here, Catherine is asking, what are your thoughts on asset allocation for a person who will receive about 50% of their retirement income from a federal index pension? Would you stick with 60-40 or drop that to 70-30 or even 80-20?
Yeah, you know what? Again, here's where it comes down to a risk tolerance level. Now, the master of index investing, John Bogle, would suggest factor in any pensions, kind of treat it like a bond, right? So now you're starting with a 50% cash or bond allocation because it's guaranteed, likely indexed to inflation, right? So you can certainly go a little more aggressive on the other side, but once again, figure out what you need from that other bucket, right, from your portfolio. And maybe you don't need it to earn a lot. So that'd be another consideration. Like, do I really need to put that at risk? Maybe a conservative model is best for that because I really only need that to cover at 2-3%. Others will say, well, I've got that security of that pension bucket there. You know what? I want to leave more of an estate. I want to take on more risk. I have the risk tolerance level for it. So I think I'm going to take on more. And again, that is a sound strategy, if you will, because they know that, they're not relying completely on our portfolio, right? As many of us will be. And it's a great position to be in. But once again, just make sure you understand the ramifications, understand the risk level of, all stock versus, an 80-20 versus a 60-40 versus even a conservative. Maybe that's like 70% bonds.
Okay. All right. Lots of great questions here. So some variety too. Do you use technical analysis or relative strength to select your ETFs to rotate in and out of, or something like the muscular portfolio strategy?
You know what? No, I've researched that a lot, looking for,
Have you?
any kind of technical analysis that might work. I understand there's a few things like momentum and such. No, I think I'm just a fan of, I don't hold core stuff. I've done my research on how I slant my portfolio. It's nothing exotic, but from there, I just count on rebalancing, if you will. And Brent and I've talked to, but even with, with the energy stuff, it's cyclical. So, just rebalance, take some profits here and there. The really growthy stuff, like my wife has, when I skimmed the VIG index back in 2015, her portfolio got a lot of the growth assets, if you will, the tech. And she's like, at some point, her returns are like 50-60% above the NASDAQ. Like, it's just such a incredible growth bucket. And we just, that's what we do anytime. We just trimmed it along the way, right? Knowing even over the last year or two that US stocks were terribly expensive. So it's gone to cash and it's gone to some bonds. And if we do get a bear market, it'll go back. So again, that's why I wouldn't mind seeing, don't want people to get hurt, but I wouldn't mind seeing a real correction, a real bear market. I think we need it. And then a recession is likely on the way, but don't quote me on that. I don't know for sure, but I think they're going to have to create a recession to kill inflation. And if they don't do it, and if they're being smart, the risk if they don't kill it the first time is we get stagflation, right? So again, always right on the side. Nobody knows for sure what will happen, but I think we need to be prepared for the recession as well.
Right. All right. Ian's got a question. I'm not sure I completely understand it here, but
Sure.
we can work through it together. So hybrid retirement approach, it's about that. At what interest rate would it make sense to pivot to a fixed income example? Although it likely won't require 21% interest rates like the 80s. Can you imagine buying 8 to 10% GIC in lieu of some asset allocation to equity?
Yeah, great question. And if there's not many of them out there, but if you talk to investors or advisors who are actually around, back in the 70s and 80s, they didn't buy stocks, right? Like, they're going, why would I buy a stock when I could get like a bond or even a savings account, whatever went up, like short-term bonds for 18, 19, 20% or whatever. So they were not buying stocks, and the dividend yields were probably nowhere even close, right? So again, that's that battle we talk about, right? That, the more yield we get from bonds, the less attractive the stocks are, right? Now that's an extreme situation, but again, that's why stocks are coming down in the US too, right? Fears of inflation and rising rate environment, but it really is that, bonds are going to start to compete. Already the yield is much more than the US market. And yeah, I mean, but again, that's why I think, we've talked about this too. And somebody wrote an article the other day, which is really good. I think it was Dan Bortolotti, just saying, like, treat bonds like a long-term asset, right? Everybody says avoid them. But if they're part of your portfolio, yeah, why not hold your nose and buy them as the yield goes up, right? Like, eventually it's going to end, and there'll be a correction or recession or whatever, and we'll be glad we have those bonds, right? Be prepared again for them not to work for a while, because we don't know what will happen with yields. But again, it just really comes back to the core of a balanced portfolio, right? We're going to have that yield. And even today in bond ETFs, those yields are going to start ticking up as they kick out the other bonds that mature, get close to maturity, and new bonds coming in and having a higher yield. So that's going to climb up. But yeah, there will come a time, if that keeps going on, where, folks might bail on their stocks and they'll see much more value in the fixed income.
If you had to create a list for people in retirement stage and said, don't do these things, this is when things fall off the tracks? Like, what would be some of those kind of maybe emotionally driven, maybe
Yeah,
other, I don't
I
want
think
to
the
call them mistakes.
basics would be like, be really careful if you have an all equity or an equity heavy portfolio. Especially if it's your first time, because it feels really different in retirement, right? Like you don't get a second chance. Like in the accumulation stage, lower prices are great. We don't get a second chance to refill that, right? And if we get scared and we sell, that money's gone and can impair retirement like for good, right? So I think we really need to watch our risk tolerance level. Don't guess about what we're doing. Whatever it be, like even if a checkup is 1,000, 1,500, 2,000, 3,000, whatever, it might be the best money you ever spend, right? Because it could save tens, who knows, hundreds of thousands of dollars, depending on how much you have, right? So I think it's a period where, self-directed accumulation is pretty easy, right? We just keep buying, invest within our risk tolerance level. Retirement is just much more complicated, and I think most will need help.
And what
Risk tolerance and get the help you need.
And when do you flip to that retirement way of thinking? Like at what point before you actually quote unquote retire? Because some people kind of semi-retire or so I guess everyone's
and
slightly different.
Done posts where the retirement risk zone, and that would start at least 5 years before retirement, right? Where we need to start planning. Some say even with 10, given that markets can tank even for 5-10 years or more, right? So yeah, at least probably 5. And think, even with that, what you could do even within 5 years of retirement, you could just start with if you have a portfolio income or new monies that you're adding, you might just start building up the safety part, right? That, we don't have to do a complete rebuild at that point. Say, oh, I'm going to sell my stocks now and move to bonds, because you've got 5 or 6 years, you can just build up that bucket, right? So you can keep your stocks, if you will, right, and just start building the other side. Now stocks go crazy and you find something that is really expensive and it's just treated you well, you might do a bit of rebalancing as well, but pay attention to the retirement risk zone for sure.
Okay, I'll get back to a few more. Those are the little itches I was wanting to scratch, so I thought I'd ask. Hopefully it helps other people too. So Suzanne says, I put 10% US equities in a TFSA to diversify. The rest are Canadian ETFs. In your opinion, is it better to have all Canadian in there? I have some US in non-registered NRSP as well, she says.
Obviously, it's good to have the US to fill in the the portfolio holes. Again, because there's just sectors that we don't cover. Canada's, we're banking, resources, we've got some telecom in there, but if we're buying the market, it's not much more than the financials and our resource stuff, right? So yeah, use the US to fill in those gaps, if you will. Be careful of the Canadian home bias, for sure. Again, even Canadian companies don't have a lot of international exposure, right? Our banking has some. They had some good numbers today. And if that question really is, I'm not sure if it's also on holding, Canadian dollar ETF versus a US dollar. Yeah, keep in mind, we're going to lose the withholding taxes for US and the tax-free. That said, again, I wouldn't let that consideration drive the bus, if you will. And again, we can also decide to hedge or not hedge too, but most would say, don't hedge your international, don't hedge your US dollar assets, gain from the exposure. That's a risk management, right? To have stuff in dollars outside of Canada.
I see. Okay. And does it still hold true, that whole Canadian, US, international kind of in accumulation phase? You kind of find your balance there. Maybe it's 40, 40, 20 or something like that. Does that still play out in retirement?
Yeah, I think, many will say it's always important, and in retirement too, because of currency risks and such like that, right?
Okay.
Some will make an argument that for international stocks, we don't need much beyond US, because you're owning a lot of typically like international, mega stocks that gain, some of them get like 30, 40, 50, 60% of their income overseas, right? That said, I think it's probably still a good idea to have some direct international exposure, whether it be international developed markets. We might be careful with emerging markets. There's good growth prospects there, but again, I'm not sure we need to, we're not trying to, knock the lights out in retirement all the time, right? There's really good demographics for emerging markets. But if we found out recently, right, with Russia and Ukraine and what's happening with China, there's increased risk there, right? And a lot of those countries are having currency troubles. They don't respond well to the strong US dollar. So I think at least Canada, US, and then you might layer in a slice as well of a developed international.
I see. Okay. All right. Charlie wants to know about, you says you had highlighted HBAL a while ago.
Mhm.
So it seems to trade really thinly on a daily basis, and it's a 70-30 split higher on tech. What are your thoughts on it going forward?
Yeah, still love that. Again, that's like brings up a good point too, because many will say, as the point of the article was too, that the new 60-40 is 70-30, right? Because bond yields are low. They've crept up a little bit from the time that was a big chorus of avoid bonds and such and ramp up. Still like it. It's really, I mean, it's tax efficient, of course, that one. Like it a lot. And I really like the strategy too, because it'll have a bit of a barbell, right? It holds the growthy NASDAQ part of it, which is more risky, but it holds the long-term treasuries as well, which is, one would say, the worst of the bonds, if you will, because they're so susceptible to the rates, right? But those are typically going to go in either way, and they get a nice rebalancing opportunity, right? So I think it's going to take a way to play out. Those stocks and bonds and sectors are trying to find their lane these days, right? They haven't really, and again, the lane won't be picked until we discover what kind of economic environment we're in, right? If we go into recession, for sure. Again, we've seen like the long-term treasuries have been going up recently, right? Because they're signaling recession. So a fund like that, and even what I would do in our portfolios, because I hold some long-term treasuries, is once it gets enough, and again, you're going to sell those and just basic rebalancing, you're going to buy those growthiest assets, which is the NASDAQ QQQ, right? Which is a wonderful ETF. Somebody said the other day, if you could only hold one ETF, what it would be. And I said QQQ, right? I would just keep piling in. It's expensive now, but if you're saying I can only hold one, I like that over the market, because again, it's forward thinking. It's all about disruption,
Right.
and it's really volatile. But that gives the opportunity too, right? If we can buy it on the way down, and just again, dollar cost average, we're just going to keep adding. Yeah, did I cover the question there? Or did I go off on a tangent?
I'll let Charlie let us know if there's more there. All right.
Oh, it was just, yeah, the H, but yeah, no, I think it's a great
HBAL in terms of state,
ETF.
where that fits in, I guess, again, this is all part of the risk tolerance too, right? And longevity.
Yeah.
And Trey's asking, can you use the longevity plan? I don't know what that says, in a HODCO, HODCO. Do you know what that means?
No, maybe they can type in and,
holding company, maybe? Is that
oh, yeah, again, I wouldn't know that. So that's where you're gonna that's where you're gonna go. That's why we need that financial planner, right? And even a question like that, you're not going to go to probably cash flows and for that kind of stuff. You're gonna go to a financial planner and or an advisor, but get a good answer on that as well, for sure. Yeah.
Got it. Okay. Some good complex questions here. What are your thoughts to be more aggressive, i.e. VGRO and a TFSA, if you won't be making withdrawals for 15 years, and a 60-40 with more bonds and RSP where funds would be drawn sooner? So you got to kind of have balancing,
Great observation and great question, for sure. Like when you're 15 years and you want to go that, I think it was VGRO or something, was it more growth?
It sounds like they might use RSP first and then probably have enough for 15 years out, kind of idea.
Absolutely. A great point. So I have posts on this on my site too. You do want to match the risk level of the portfolio to your time horizon, right? And I have a chart, I believe it's also in the asset allocation page. So you're right. Like when you say, you know what, I'm going to deplete my RSP like really quick in 7 years, you're typically going to manage it like a target date fund, right? So even again, if you want to see an example of that, go to my post on the Just Wealth for RESP, because again, that is the place for Canada for if you want to manage the RESP. It'll show the tables and the asset allocation, like, maybe at, when you're within 3 years of the education start date, same idea, you're at 80-20. Then at 2 years, you're at 90-10, being bonds to stocks. And then the last year too, they are totally into a bond portfolio and probably short term. So it's right. If we have a shorter time horizon, let's say, we're going to and this really quick, we're going to harvest RSP, and then it's non-registered, which is longer, and then it's tax-free. Yeah, the further you go out, the more risk you can take on. So that's a great observation and a great idea too. Yeah, if you
Part of
have
that
a risk
is,
tolerance,
let's say, building
let the
that
other stuff grow.
plan out and realizing, if you project yourself to live another 40 years or whatever after retirement, then I guess that's the kind of the phasing of it.
Growth is good, and as I've said, there's even a spot on the or a post on the site where the balanced growth model is the sweet spot. There's so many periods where we're not even rewarded for taking on the additional risk of an all equity over a balanced growth, V grow, X grow, whatever. That those market corrections become the great equalizer, right? And that's a wonderful way to go, especially for 10, 15 years. So it's absolutely.
What about ARKK?
Oh, the ARC stuff? You know what? It's not going well now for Kathy, of course. So I think, she probably was identifying great companies most of them with no earnings and great trends. She knew that, but she's just running headfirst into potentially what might be a recession, right? So now, in rising rate environment where companies with no earnings get killed. So again, it may still work as long as the companies don't run into financial trouble, right? So again, I wouldn't touch it right now because it's a real risky asset. But for those who want to, play that high risk, high reward, it might be worth a look. But in retirement, again, I wouldn't play with too much of the high risk stuff.
Okay. Ian's wanting to know what is the current yield for the 7 ETF retirement portfolio?
Oh, you know what? I didn't look at the last time. I would bet that it's probably close to 3. I could, what I'll do is I'll look at that and I'll put it in the post. So look for an update. I'll try and get it in there tomorrow. But again, that's one of those things where, one could ramp up the yield if they want to, but just pay attention to what you're moving from, whether it be the bonds, right? And it comes into how sustainable do we think that yield is, right? Once again, love VDY, but it's heavy into financials, and love the mix of the BMO monthly income is actually even more diversified, right? You might even, again, these are just ideas, and you might even flip that. You go, you actually know, what? I want the BMO stuff because it has more high yield stuff, but it's more globally diversified, right? So maybe I want an even mix of that, or maybe I want more of the BMO and less of the VDY. So you could ramp up that yield. And I think the monthly income, I think that's close to 4%. And I believe VDY these days yields probably about 3.8%, right? Because those stocks have gone up like crazy, so that the yield has dropped down on the VDY. And the banks, a couple of them announced today, and the dividend increases are only in the 3, 4, 5%, so they've dropped down a little bit. So the banks and financials might be a bit of a stall on the big increases.
Great. Wally wants to know, what's the main indicator you follow to see a market turnaround? Many people I know are holding on to cash.
Great question. Yeah, there's too many moving parts. I've never seen so many swirling risks at once. But what I will say is inflation is driving the bus, right? We can talk about Fed says this, Bank of Canada governor says that, this analyst says that. It's inflation is driving the whole bus, right? Like they have to either get some help on inflation or kill inflation, either by, we talk about trying to get a soft landing, if you will, like bring the economy down enough without causing a recession, which is pretty tough. So if we look at the last 13 periods or something, they're like 3 for 13. It's pretty tough to get that soft landing, right? So I don't think we need to guess. If somebody is holding on to cash, again, the markets, and I did a post the other day, like the Canadian markets are historically cheap right now, right? On forward basis, the US and even the growth assets are back with pretty close to historical range, but it's forward earnings, right? So forward multiple. So those could disappear, of course, with a recession. What I've read mostly is that, US markets have to come down 10, 15% at least to get into the historical range of fair value. But Canadian stuff looks great. So, I mean, if you want to play a little bit of active allocation, you can certainly think, well, the Canadian stuff's great, good yield, valuations are wonderful. We're like half price or less than US stocks, right? So there's you should always find a way to invest your money, in my opinion. But if you want to get greedy, certainly hold back some cash and hope that you get a 40, 50% correction, but that's a tough game. And nobody knows what would happen. I would say really start dollar cost averaging. If you want to pay attention to value, you would go more to Canada and even developed markets, right? Like European, UK. They're much cheaper as well. That said, keep in mind the best companies in the world, they're in the US, right? There's no doubt about that. They're just very expensive and there's a valuation reset, right? Like I want to go back and add more to them. Those are certainly the best companies in the world, and growth will be scarce in the future. Keep in mind as we head into, even the the COVID correction, growth rates for US, Canada, the developed markets, it is nothing. It's so low, right? We might go back there, so we will want to hold some growth assets, even in retirement.
Is there any? Okay, last question here. We're near the end of our time here, so. Yeah, I guess there's some comments. You can look at the chat here. In the chat, it'd be helpful for us to know if what would you like Dale to cover in a future call. So if you have any further questions or topics, again, we've already talked about next time doing a dividend income approach, right? We talked about the next call.
And again, feel free with questions that you get answered here. Certainly feel free to send me a note on the site, and I certainly get to it eventually. I really enjoy the process.
I guess we're assuming everyone knows that information. Do you want to post any of that in the chat, or let people know how to?
Yeah, just on the blog, there's a contact form.
Okay.
They just input the question there. It'll come right to my Cut the Crap Gmail.
Okay. We'll have a lightning round here, so we got a couple more. Got 2 minutes left here. So Suzanne says, I'm close to retirement, a little worried about the risk of buying HXT and HXS for non-registered. Each will be 30% of the account. Is it a bad idea to use, i.e. VCN for half of HST to decrease risk? I realize they are similar, but worry about the government may change the tax rules on HXT and I could get stuck with it.
Yeah, I would say, that's a detailed one. Send that one to me via the contact form or email, and I'll look at that, because there could be tax considerations and stuff. So
okay,
I can address that separately. Yeah.
Okay. So Trey says dividends for sure. So we'll definitely focus on that. And then the last question here, I think we'll close with this one. What's your opinion on using National Bank versus Questrade for stock or ETF purchases? So that's very specific.
Oh yeah, no, they're both highly rated. They're both really good. I use Questrade, and it's really good. It was easy to set up. That said, if you just want to do Canadian stocks and stuff, or like Wealthsimple Trade is incredible. It is amazing. I had that account open up in honestly 5 minutes, even all the security check and everything like that. And it is so seamless to enter. Questrade is great, and obviously you can buy ETFs for free. But it's just not as fluid, if you will, as and even I use TD Bank brokerage, and that even seems a little more smooth than Questrade. Questrade's still top notch, but I think for my money, I think they need to work on the mechanics of how the site flows. I'd like it to be a little easier. I think they could, and I do talk to them once in a while. I think they could learn a little bit more from Wealthsimple Trade. Given the trade is it's not a discount brokerage for Wealthsimple Trade. It's a trading platform. But I think Questrade could use a little bit of that.
Awesome. Okay. Great. And there's some other questions here I'm sure Dale can respond to and in the blog. Right?
Yeah, absolutely. Yeah.
On Twitter or wherever other channels you follow Dale on. So so let's close there. Again, I really appreciate everyone showing up again. I appreciate Dale, all you've shared here, and I learned a lot. And
thanks for showing up, everyone. Don't be shy. Send those questions through. And thanks, Brent, too, for putting this on. Greatly appreciated.
Lots of fun. Yeah, good stuff. So we'll watch Dale's channels, and we'll schedule the next one here for dividends.
Okay, and I also will I'm voicing that presentation to turn into a video. So again, I'll put that on my site. You may know it, but look for the YouTube channel for Cut the Crap Investing as well. We'll put that, and I believe we'll put the question period in there as well.
Right. Yeah, exactly. Good stuff. Thanks, everyone.
Thanks, everyone.
No.
Appreciate you showing up.